Chapter 19. Change in a group structure. Change in a group structure. Parent entity accounts. Group accounts. Acquisition of a subsidiary. Step acquisition. Transactions within equity control neither lost or gained. Control already exists. Decrease in the NCI. Control is not lost. Increase in the NCI. Disposal of a subsidiary. Control is lost. Entire disposal. IFRS 5 disclosure, discontinued operations. Associate shareholding retained. Trade investment shareholding retained. Subsidiaries acquired with a view to subsequent disposal. Acquisition of a subsidiary. Mid-year acquisitions. A parent entity consolidates a subsidiary from the date that it achieves control. If this happens partway through the reporting period, then it will be necessary to prorate the results of the subsidiary so that only the post-acquisition income and expenses are consolidated into the group statement of profit or loss. Step acquisition. A step acquisition occurs when the parent company acquires control over the subsidiary in stages by acquiring more shares in the company at different times. Type 1. No control to control. This is buying shares in company, moving from just having an equity interest in the company to having control over the company. The pro forma to follow for goodwill calculation is fair value of previously held interest, fair value of consideration for additional interest, NCI at acquisition, less FV of net assets at acquisition, goodwill at acquisition. Type 2. Control to control. Here, the parent buys additional shares in the subsidiary and increases the shareholding in the company. Hence, NCI holding decreases. The movement here is subsidiary to subsidiary itself. No profit or loss arises on the purchase of the additional shares and goodwill is not recalculated. Adjustment required to NCI and other components of equity can be calculated by cash paid, credit, decrease in NCI, debit, decrease or increase to other components of equity, debit or credit, balancing entry. Disposal of subsidiary. Shares in a company may be sold in parts or full. The profit or loss on disposal should be reported as a separate item on the face of SOPL in individual financial statements. It can be calculated as sales proceeds, carrying amount of shares sold, profit or loss on disposal. Type 1. Control to no control. This happens when a parent disposes its shareholding and loses control over the subsidiary, but retains some equity interest in it. If the remaining holding after disposal is 20 to 50% of the shares, then it has to be recorded as investment in associate using the equity method. If the remaining holding after disposal is less than 20% of the shares, then it has to be accounted for under IFRS 9, Financial Instruments. The following template can be used to calculate the profit or loss on disposal. Disposal proceeds. fair value of retained interest, less interest in subsidiary disposed of, net assets of subsidiary at disposal date, goodwill at disposal date, less carrying amount of NCI at disposal date, profit or loss to the group. Type 2. Control to control. This is when parent disposes of some shares in the subsidiary but does not lose control over it. The change here is decrease in parent shareholding and increase in NCI. No profit or loss arises on the sale of the shares and goodwill is not recalculated. Adjustment required to NCI and other components of equity can be calculated by cash proceeds received, debit, increase in NCI, credit, increase or decrease to other components of equity, credit or debit, balancing entry. Subsidiaries acquired exclusively with a view to resale. A subsidiary acquired exclusively with a view to resale is not exempt from consolidation. However, if it meets the held for sale criteria, then it is presented in SOFP as a disposal group held for sale. This is achieved by amalgamating all its assets into one line item and all its liabilities into another. It is measured both on acquisition and at subsequent reporting dates at fair value less costs to sell. Disposal of associate. A disposal of shares in associate means losing significant influence over it and moving from associate to IFRS 9, and it should be recognized at fair value. A profit or loss on disposal will arise in the consolidated statement of profit or loss. This is calculated as follows. Disposal proceeds, fair value of retained interest, carrying amount of associate at disposal, profit or loss to the group. Exam focus. The question 1 of SBR exam would be on group accounting. It would not test on preparation of full consolidated statements. Rather would test on preparing extracts from these statements and to explain the numbers that have been produced.